40inbox.com here. So we're going to be checking out an article called 3 Ways to Get Started Investing for Under $100. So I thought this would be a pretty interesting read. So let's get right into it. Investing in the stock market can be expensive, especially if you're buying individual stocks. Each stock can sometimes cost hundreds or even thousands of dollars per share, and you could easily spend several thousand dollars building a diversified portfolio. Fortunately, there are more affordable ways to get started investing, whether you're on a tight budget or simply want to get your feet wet before diving into the stock market. There are a few options to get you started for $100 or less. Number one, contribute to a 401k or IRA. Contributing to an IRA or workplace 401k is perhaps the easiest way to begin investing because it doesn't require any advanced knowledge or research. Once your account is set up, all you have to do is contribute as much as you can afford and then leave your investments alone. If you're investing through a 401k, you may be able to simplify the process by setting up automatic transfers from your paycheck to your account. With an IRA, you can usually transfer a set amount of money from your bank on the schedule you choose. One of the best parts about investing in a 401k or IRA is the flexibility. If you can only invest a few dollars a week, that's okay. If you want to contribute a few $1,000s at once, you can do that too, regardless of your budget. These accounts make it easy to start investing. Now, here's the thing, right? All these are probably going to be like good for you to actually go and try to do, right? But again, we always push for this is that you always want to get debt free first before you start investing into retirements, into like retirement accounts and all that kind of stuff, right? And the reason for that is because you want to minimize the amount of risk that you have so that you have massive amounts of cash flow coming in so that you could just start like shoving as much cash as you can into these investments without really any risk to your lifestyle or to yourself in general, right? Because a lot of people don't really ever factor in risk. So if you're someone with a massive amount of debt, living paycheck to paycheck or close to paycheck, and you start trying to invest money right into these retirement accounts, even though maybe on paper it might look like a better financial decision, if anything goes wrong in your life, you're basically screwed because what you're gonna take out a loan on your investments and then you're gonna get penalized and you're gonna be taxed nearly like half the amount that you pulled out. Like it's gonna be brutal, right? And like a lot of people just do not factor in risk when it comes down to like making money or investing for your future, right? And this is the way that I put it. You want to be debt free so that all the money that you basically get are being put towards your future, right? Because if you end up having payments for like your car, right? Guess what? You're paying for that car business's future, right? You're making monthly payments to this car so that they are continuously making more and more and more and more money where you are negatively impacting your future. Whereas you could put that exact same amount of money into an ETF, into your 401k or IRA and literally become a millionaire when you're retired, right? And this could be easily something like a few $100s a month, like a car payment amount of debt. Instead of it being debt, you'll literally go towards investments, right? But because you have that card payment, you're actually going into a negative net worth, right? And we want you to get to a situation where you are just constantly in a positive growth in terms of your net worth, right? And if you're debt free, it's a lot easier to do that because the amount of cash flow that you have coming in with no monthly payments is massive. And it also gives you so much margin, right? In terms of like your expenses versus your cash flow, like your income, that you could end up investing towards your future and living a really good life as well without really any risk to yourself financially, right? Because when you're debt free, you could basically have money sitting in a bank account if you really want to do it for like excess cash where you could literally just blow $500 for no reason. You could go on a trip to, I don't know, Saudi Arabia, I don't know, or Australia. Although Australia would probably be a horrible place right now, but you get what I mean. Like, you want to be able to get yourself in a financial position that you have so much freedom to basically do whatever you want while still growing your net worth without having the stress of having to make your monthly payments. So, number two, invest in ETFs. Exchange traded funds or ETFs are investments that include many different stocks bundled together into a single fund. Some ETFs are broad, such as the S&P 500 ETF, which includes all the stocks within the S&P 500 index itself. Others are more niche, and many only contain stocks from a particular industry. ETFs can make it easier to build a diversified portfolio when each fund contains hundreds or thousands of stocks that lowers your risk. If a few stocks within the fund don't perform well, it won't have a drastic effect on your overall portfolio. This type of investment can also make it easier to branch out into certain sectors of the market. Say, for example, you're interested in buying tech stocks, but you don't want to spend hours researching different companies. If you invest in a tech ETF, you can gain exposure to dozens or hundreds of tech stocks with a single investment. Number three, buy fractional shares. So if you prefer the hands-on experience of buying stocks without the hefty price tag, fractional shares may be your best option. With fractional shares, you can buy just a small slice of a share of stock for a fraction of the cost. For example, rather than buying a full share of a particular stock for, say, $200 per share, you could buy 1/10 of a share for $20. Not only can fractional shares save you money, but they can limit your risk too. If you only have $100 to invest, for example, you could buy one full share of stock for $100, or you could buy 20 fractional shares of stock for $5 each, which will create a more diversified portfolio. Of course, the smaller your stake in a company, the less you'll see in earnings. However, fractional shares can make it more affordable to build your base portfolio over time. You can gradually add to your positions in each stock. Investing in the stock market can be a smart financial move, but it's important to avoid contributing more than you can afford. So, with these three options, you can start your investing journey without breaking the bank. So, I do kind of like all of these. And now for the fractional shares, I don't like the idea necessarily of doing these in individual stocks, but a lot of platforms nowadays, like for example Robinhood, would allow you to invest fractional shares when you're buying like an ETF, right? So you could buy like something like the S&P 500 with fractional shares, right? So for example, you could literally buy $100 worth of a ETF of the S&P 500 and then put it and set it to where it automatically reinvests the dividend produced by the ETF. So that will also buy fractional shares as well. So you could just keep on putting a small amount of money when you can into that ETF, and the ETF over time will buy more shares of itself. So it's just basically a drip, dividend reinvestment plan, right? So you're just constantly building your stake in that ETF. You're building that account, right? Which is a nice way to think about it, right? Because what people need to understand is never really actually about the price of like any of these stocks. It's the percentage of return per year, right? That's what you got to really worry about, not really the price of the stock, right? Like for example, a $10 stock going to $20 is the exact same as a $100 stock going to $200, right? The exact same, right? In terms of percentage growth, right? So it doesn't actually matter in terms of the price of the stock, it just matters the percentage of return. And if you are able to average that 10% return that we mentioned in a previous episode, that with just $500 a month in a 10% plus annual return investment, you're going to be able to retire a millionaire in just a few decades, right? So that's something to really think about. And this is the best thing about, personal finance. You don't got to overcomplicate it, and it's basically pretty simple, right? So if you want to learn how to get a debt, go to 40inbox.com.